for you today. Not a normal video from me, but this is going to be another template. Maybe I'll do more of these. This one here, guys, is so you guys can play with compounding interest and play with those dividend stocks to figure out when you would be able to retire off the income. So if you want to take a look at this, I will put the template down below. Please remember to like and subscribe for more. I would appreciate it. It's great to see that interest. So let me run through this. So what I did here is I just picked a fund. This is PDI. It's something I'm usually putting money into, God willing, on a monthly basis or more. So I put some dummy numbers in here. This is PDI stock price, though, from Google Finance with the Google formulas, because this is a Google sheet. This is the annual dividend. I did type this in, so it's what I checked last time I checked, and then this is that percentage of the dividend based on the price for the annual dividend. Nice high dividend percentage. This is a closed-end fund that trades bonds by PIMCO. There were two other funds that were recently merged into it, but yeah, this is a classic, classic fund here. So if you take a look at this, you have the initial principal. You can play with this number. I put it as 100K. Your interest rate set to whatever the dividend is of the stock that you pick. You could also put a few stocks up here and then blend the dividend rate and weight it based on number of shares and all that kind of fun stuff. If you want to get into it, maybe I'll do another video like that later. I've set the tax rate at 30%. Now, most of these dividends are going to be qualified dividends, which means you'll probably only have to pay 15%. So you could change that if you'd like, but just to be safe, I did 30, be a little conservative. Then that gives you your annual interest rate after tax is about 7%. So that's what you'd be earning. So if you take a look here, let's say then this is row 8. This is your additions, each compounding period. So here I have this compounding on a yearly basis. So let's say you're adding $5,000 a year. So if you look at this, you say starting balance, and this goes through all the years. I also set up the spreadsheet so that you can put in your monthly spend, and which obviously extrapolates out to your yearly spend. That way you guys could see as you scroll down here through the years where you reach a point that your monthly income, right? Your monthly income per month here, income per month here is greater than or equal to your spend per month. So it's at this point here, in this case, it'd be in 28 years, right? That's kind of hefty. In 28 years, you'd be able to retire off of this, right? Off this income. And then you wouldn't even have to spend the principal as long as you keep your rates the same. You can see that updated there. That's because the price price just updated to 2502. So that's cool that it does it every once in a while here. I think it's every 20 minutes it clocks off a new number. So if we play with these numbers a little bit and we say, okay, well, what if I add $5,000 a month, right? What if I'm going to save quite a bit? And I'm adding $5,000 a month, so that 5,000 times 12. Now you're adding 60 a year. Look at that. Now you made it. This is conditional formatting over here. Now you make it in just 11 years, and you're almost there on year 10. And not to mention, after those 11 years, you also, God willing, the price stays the same, have $1.2 million in cash or in stock that is liquid, right? And you can spend it and do what you want with it. If you wanted to, but what you really want to do is leave that in there, leave those dollar workers running and earning paychecks so that you can live off the interest, and then it just continues to compound. And as this compounds, God willing, you can have a better and better, you can do more and more things, right? So in this scenario, let's say you have 10K or 11K a month, then that's in 11 years, and then another 10 years after that, now you're making $30,000 a month. That's with contributions at the same. So if you're still contributing to it, maybe eventually I'll adjust the spreadsheet so that the contributions can end at a certain point. Because I could do that here. Let's say after you've reached the point you want to get to, you no longer contribute. You go ahead and retire, you stop working, and then you just let the compounding interest take over. And then you're here, and this would also assess your rolling the money back in. So let's say you roll the money back in, but if you retire, you're pretty much going to set yourself here. So even if you don't make contributions, you're really not going to make interest off of those. It's not going to be compounding interest anymore. It's just going to be 10%. So you'd have to change a lot of these numbers here to get to that. But that's all right. I can mess with that spreadsheet as well. And a future date to show you guys that as well. But this is just the basics so that you guys can play with this number. Let's say also you don't want to add this much a year. let's say, you're just going to add $10,000 a year. And maybe you don't have $100,000 to put in. You're just going to have $20,000 to put in. And then where do you make it? It's going to be a little bit further down. You make it in 29 years. But if you're only putting $20,000 in, you're only paying $10,000 a year. You're probably also not spending $10,000 a month. So then you make it a little earlier in the 21st year. Then you could retire at the same income that you're doing, or you just keep pushing it, right? You just keep pushing it so that when you retire, you can live even better than you're living now. So, God willing, better and better and better. So, I hope this helps, guys. Remember to like and subscribe. I will continue to add to this for you guys. I'll try and factor in some inflation and things like that, which I could do here with the tax rate. I could add an inflation rate and things along those lines. So, hope this helps, guys. Remember to like and subscribe. Enjoy the day.